Welcome back, everyone. This is Tom Vylord. Today we're going over section number 5, and in my opinion, this is the most important topic when it comes to investing. Today we're going over an intro to fundamental analysis. And again, in this section, we are going to be talking about a couple specific companies, and that is to be taken as illustrative and educational purposes only. We are not your financial advisor, so we can't give you, and we're not going to give you specific investment advice. Once again, any company we do talk about is to be taken as educational and illustrative purposes only. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price, Warren Buffett. And in this section, we're going to teach you what to look for to determine if a company is wonderful or not. And here's what we're going to learn in this section. What is fundamental analysis? What are earnings, earnings per share, and earnings per share growth rates? Then we're going to explain what the price to earnings ratio is. Then we're going to take a look at the company's cash flow and debt. Next, we're going to take a look at the company's net profit margins. Then we look at return on equity, return on assets, return on capital. I'm going to show you where to find the sales and revenue. And then we're going to read the news regarding any company we may potentially invest in. Most investors and traders will usually select one of two forms of analysis to help them find winning trades. The two most common forms of analysis are fundamental analysis and technical analysis. We're going to cover fundamental analysis in this section, and we're going to teach technical analysis in section 6. Fundamental analysis is a method of evaluating a company by looking at the financial and economic data to assess its intrinsic value. In layman's terms, we want to know if a company is a financially sound business, and we want to know what the stock price should be. We do this by looking at some key numbers within the annual report and the quarterly report. Fundamental analysis determines the health and performance of a company, and this analysis is going to help us identify fundamentally strong companies or industries that we may want to invest in. Advanced traders may also use fundamental analysis to find fundamentally weak companies or industries to short the stock. If we know what the stock price should be, then we can determine if the current price represents a bargain where we may want to buy in. It's also going to show us if the current price represents a fair price, and most of the times this is where stock price will probably trade. And also it's going to show us if the current price is overvalued. When a stock is overvalued, we do not want to buy new shares, but if you own shares, this could be a good time to sell some of them. Fundamental analysis helps us reduce or eliminate the amount of emotions that comes with making an investment decision. It tells us if the company is good or if it isn't, plain and simple. And if that is a good company, then it can be a potential investment. If it's a bad company, we move on. The man who really made fundamental analysis a preferred way to look at stocks is the man himself, Warren Buffett. So the first topic here are earnings. Earnings are the amount of profit that a company produces. Earnings per share, also known as EPS, is the profit the company made divided by the number of outstanding shares. EPS is probably the single most studied number in a company's financial statement because it shows a company's profitability compared to what the analysts expect. Earnings are looked at carefully because they closely represent a company's performance. When analyzing a company, we want to make sure we see two things. Obviously, we want to see that earnings are growing, but just as important, we want to make sure earnings are growing consistently. We don't want earnings to go up huge one year and then get crushed the following year and then up again. That's a roller coaster ride. It's also a business that's not predictable. Ideally, we want to see that EPS is growing smoothly each year. My rule of thumb is to find a company that has earnings growth of 10% each year or greater. The only caveat to that is if a company is a huge blue chip company, is very conservative, like a Coca-Cola, Procter & Gamble, Disney, etc., it can be lower than 10% as long as the earnings are consistent and predictable. And here's an example of a company with great earnings. And I got this information from a resource called Value Line. And what you see here on the left, Disney has grown their earnings over the last 10 years at a rate of 15%. Estimated earnings are a little bit lower, 10%. And their earnings predictability score out of 100 is a 100. The 10% rule applies and must be followed to smaller, less established companies. We also want to see earnings predictability because when we use future earnings to value a company, which we're going to teach you in the Value Investing and Options Trading course, we want our estimates to be as accurate as possible. I use Value Line to see what earnings predictability score a company gets, and I want to make sure the company has a score between 80 to 100. Disney has an earnings predictability score of 100. That's the highest score that Value Line awards. I can do a much more accurate future price target with a company that has predictable earnings. They have consistently grown their earnings at 10% or better from a 1, 5, and 10-year time period. And here are their earnings year over year. Every year, with the exception of 2009, and that was a result of the 2008 crash, they've increased their earnings each and every year. So from 2006, it went from $1.61 to $1.92 to $2.26. Then you had the one drop because of the great crash that we saw in 2008. And then from 2010 all the way to 2017, each and every year, their earnings per share has increased. The perfect example of the type of earnings growth and predictability that we're looking for. And here's a disclaimer, I do own Disney stock, and this is not a recommendation to buy Disney. This is just an example. Compare that to a chart whose earnings are all over the place. This stock here is JCPenney, and they have earnings with deficits. So if you take a look at the top chart, in 2006 they had earnings of $4.88. Then their earnings went down in 2007 to $4.75. It looks like it got cut almost in half to $2.54 in 2008. And of course, they were affected by the great crash of '08 as well. So in 2009, their earnings fell from $2.54 down to $1.07. And it went up to $1.59. They got cut in half again to 70 cents. And in the next couple of years, they had deficits. So they had a loss in 2012, 13, 14, 15, and then finally started making a profit again in 2016. And in the middle chart here, where it has annual rates, where it says earnings NMF, it's not meaningful. And they have a very terrible earnings predictability score. NMF, it's not meaningful because of negative earnings. Now, if we're going to take a look at earnings to predict what the stock price could be, we want to make sure it's a company with predictable earnings. Earnings predictability score 15 is not predictable at all. If I got a score 15 on a test score in school, I've been grounded for a year. Next thing we want to look at is the price to earnings. Sometimes the best way to predict the future is to look in the rearview mirror. I'm sure we've all heard the disclaimer, past performance is no guarantee and no indication of future results, and that's true. But there's two ways to figure out where a stock price could be. Number one is to predict where it's going to be, and predicting the future can be hard. Or number two, for a predictable business, we could take a look to see what it's done in the past and use that to estimate where we think it could go based on what the company has consistently done over time. Price to earnings is how much an investor is willing to pay for a stock relative to a company's earnings. Also known as the PE ratio, this is a widely used metric to determine how cheap or expensive a company is compared to its own history or other companies within the same industry or sector. The term PE has been thrown around a lot, but a lot of folks really don't understand what it actually means, so let me give you a couple examples to help you understand it. The first example, we're going to use a lemonade stand to make things simple. Assume the lemonade stand costs $100 to start. And that $100 bought us a fancy looking stand, some nice signs that can easily be seen from the road, and of course, inventory to make the lemonade. We did that at the beginning of the summer, and by the end of the summer, it earned $100. If we wanted to sell that lemonade stand for $100, we'd be selling it at a PE of 1. Price of the business, it cost us $100, divided by the earnings, which was also $100. We would never sell it for just one time's earnings. We want to sell it for a few times its earnings. If we sold it for $300 to the enterprising kid next door, we would have sold it at a PE of 3. As a seller, we want to sell it at a higher PE. But if we're buying a business or if we're buying stocks, we want it to be lower. A PE by itself really doesn't tell us a whole lot. So is a 15 PE high or is it a low PE? Who knows? I find it very useful by looking at a company's own historical price to earnings. If historical PE for a company is 20, then a current PE of 15 could represent a bargain. However, if a current PE is 25 and the historical is 20, that would represent an inflated price. Another way to understand PE is to assume that you will buy an entire corporation. Let's say you buy XYZ Incorporated for $1 million. At a PE of 15, it will take you 15 years, assuming zero growth, to get your money back from the earnings that XYZ brings in. At the PE of 20, it's going to take you 20 years to get your original investment back. We want to get our money back sooner than later, so a lower PE is better. And lastly, divide 1 by the PE. 1 divided by that 15 price to earnings ratio gives us a 6.6% return on that $1 million investment. 1 divided by 20 is a 5% return on investment. I'd rather earn 6.6 instead of 5%. So hopefully that gives you a better idea of what price to earnings is. Cash flow per share, this is the after-tax earnings plus depreciation that acts as a measure of a company's financial strength. Since cash flow takes into consideration a company's ability to earn cash, some analysts look at cash flow as a more accurate measure of a company's financial health. Also, the fact that cash flow is much harder to manipulate makes this metric more important to a lot of investors than earnings. A company with positive cash flow has money to service its debt, reinvest into the business, pay dividends, etc. And just like earnings growth, we want to see cash flow growing at 10% or better each year. And here's the cash flow growth for Disney. And once again, from 2002 all the way to 2008, things grew quite nicely from $1.06 to $1.19, $1.70, all the way up to $3.28. It had the one hiccup in 2009, which was a direct result of the crash of 2008. And then from 2009 all the way up to 2017, it's consistently grown from $3.03 all the way up to $7.75 per share. So what you see here is you have 14.4% growth over a 5-year time period, 16.1% growth over a 10-year time period, and since 2010, Disney's cash flow per share grew at 20.2%. So very consistent. Next is debt. This is the amount of money a company borrows to invest in factories, inventory, equipment, other costs associated to run the business. Not all debt is bad, and if a company does have debt, that's normal. However, we're looking for companies that have debt that's under control. We've seen companies blow up over the years because of too much debt and leverage. There will always be a time when a company goes through some growing pains. If they have a slow month or a slow quarter and sales start to slip, we need to make sure they have enough cash to pay the bills until the business gets back on track. Ideally, a company with zero debt is what we would like, but little debt's okay too. So how much debt is acceptable? We want to see that long-term debt can be paid off with 5 years or less of cash assets. And we find this from Value Line. So I highlighted the long-term debt up at the top, and for Disney, their long-term debt is $15 billion. Sounds like a pretty big figure, but if you take a look at the cash assets on the bottom part of this chart, they have $5.2 billion in cash assets. 15 divided by 5 equals 3 years worth of cash. That's acceptable to us. We want to make sure that they can pay off their debts with 5 years worth of cash or less. Another company I like is Manpower. They have long-term debt of $850 million and cash assets of $747 million. So they can pay off their debt in just 1.1 years. Now compare that to JCPenney, which is a company that we looked at a few slides back. They have $4.3 billion in debt, but only $415 million in cash. So they are leveraged to the hilt. It's going to take them 10.5 years to pay off that debt with their cash if they can make it that long. And the reason we want a company to be as close to debt-free as possible is obvious. If interest rates rise, then a company laden with debt may not be able to afford the interest payments. And if sales temporarily drop, will they have enough money to keep the doors open? If the company does not have a sales problem, but a profit margin problem, then slimmer profits and high debt could cause serious issues down the line. As long as the company has manageable debt or no debt, it'll be financially strong enough to weather a storm. Net profit margin represents how much profit each dollar of sales generates. It's calculated by simply dividing net income by total revenue. And this is one of the most important metrics to look at in determining a company's financial health. By tracking increases and decreases in net profit margins, a business can assess whether current practices are working. Since companies express net profit margin as a percentage rather than a dollar amount, it can be used to compare the profitability of 2 or more businesses regardless of size. If net profit margin is consistently higher than the competitors, this is a great sign and is often a sign of some type of competitive advantage, or as Warren Buffett would call it, a moat. Return on equity, we also call this ROE. This is a measure of profitability that calculates how many dollars of profit a company generates with each dollar of shareholder equity. One more way to judge how good and how efficient management is at generating profits with the money shareholders have invested. We want to see ROE growing at 10% or better. We find this for free at morningstar.com. What we do is we enter the company's ticker symbol and we'll click on Q ratios. And all the way down, you'll see a tab that says profitability. And then below that, you see return on equity. Next is return on assets, or ROA. This is a measure of how profitable a company is in comparison to its total assets. It's also an indication of how effective management is at using its assets to generate earnings. It shows the investor how well it turns their assets into profits. ROA is also a good tool to compare against others within the same industry or sector. This is one of many metrics that we will use to evaluate a company. We want to make sure we see ROA growing at 10% consistently or better. The higher the ROA number, the better, because the company's earning more money on less investment. If company A has $100,000 in net income and $2 million in assets, their ROA is 5%. But if company B has net income of $100,000 and just $1 million in assets, their ROA is 10%. Company B, although they have fewer assets, is earning more money more efficiently than company A, who has more assets. The better the ROA, the better the management team is at running the business efficiently. And this is also found in the same spot. Go to key ratios on Morningstar, underneath predictability, and 2 lines above return on equity, you'll see return on assets. And next is return on capital. It's also known as return on invested capital. We call this ROC or ROIC. This is the rate of return a business earns on investor money that they are investing. It's a good indication of how good management team is at turning capital into profits. I got this example from Joel Greenblatt's book, The Little Book That Beats the Market. And it's a good illustration here to explain ROC. So if a company uses $400,000 of capital to open up a store, and that cost is going to include inventory, displays, etc., and the new store brings in $200,000 in revenue, the ROC is 50%. The $200,000 revenue divided by the $400,000 in capital equals 50. If a competitor did the same thing at the same cost that only brought in $10,000 in revenue, their return on capital was just 2.5%. Buying a company with a higher return on capital, or return on invested capital, is better than buying a company with a lower ROC. A higher ROC means there's something special about the business, otherwise its competitors would have driven down the return on capital to lower levels. A high ROC is a very good indicator that the company has a competitive advantage, also known as a wide moat. If a business doesn't have any new or innovative products or services or anything that stands out from the competition, they're going to have a lower return on capital because a competitor could come in, do the same thing, probably even at a better price, and take its customers away from them. Great tool to compare against competitors, and once again, we want to see return on capital at 10% consistently or better. Sales, which is also known as the revenue, is the amount of money that a company receives from its business activities. It's the top line on the income statement. Some sites call this top line revenue, others refer to it as sales. Sales growth is very important to look at because a business can grow and improve their earnings in a couple ways. They can improve earnings by growing the company through acquisition. That doesn't always work out. They can improve their earnings by buying back shares, and this will hurt the shareholders if buybacks are not purchased at a discount, and we go through this in much greater detail in the value investing and options trading course. Earnings can also improve via cost cutting, but there's only so much cost cutting a company can do. If a company continues to sell more of its products and services each year, then the business is in good shape. We want to see this number growing for obvious reasons, and we want to look for consistently increasing numbers year over year. If these numbers are dropping, this could be a warning sign that the company may be experiencing some financial troubles. You can find out if they're selling their products or services organically by reading the annual and quarterly reports, also known as the 10K and 10Q. Just like the other growth rates we've already looked at, we want sales revenue growing at 10% or better each year. Looking at all this financial data in the annual and quarterly report or data reporting sites such as Yahoo Finance or ValueLine or Morningstar, it's great. But for the most current information, we need to read the news. Reading the news is going to help us identify current changes in the company. This offers us information about what's happening right now, and we need to determine if that current information is good for the stock or bad. We want to see things that will show us that the company is moving in the right direction towards more earnings and revenue. And some of these things could be a positive earnings report. Stock split usually helps the stock out. Acquisition, as long as it's done correctly. If they win a new major contract, that's really going to help the stock out. We don't want to see news events that will impact our stock negatively. That's going to be an earnings miss, a major lawsuit, a major data breach, loss of a major customer or contract, accounting fraud, loss of a key executive. Here's some of my favorite resources for getting company-specific news. Seeking Alpha, probably my favorite. Morningstar, Yahoo Finance, CNBC. And with these services here, you can set up text alerts to get company-specific news anytime there is a major news event. I really like Hedge Fund Wisdom. The only drawback to this is that the data comes out once a quarter. And then, of course, Guru Focus and TipRanks are two services that I like to use frequently as well. Hope you found this section useful. This is an overview of fundamental analysis. For more detailed information of the topics covered here, as well as much more topics on fundamental analysis, go to our Value Investing and Options Trading course. Here's a learning activity for this section. I want you to use a free service. You can use Morningstar.com, which is free. You can get access to Value Line, which is free at the library. If you don't want to use either one of these two services, then look at Yahoo Finance or another one that you feel comfortable with. Pick one of the three companies on your watch list and make sure earnings per share and cash flow are growing at 10% annually or better. Next, make sure they have little or no debt. I also want you to make sure they have higher net profit margins than their peers. And finally, make sure return on equity, return on assets, and return on capital are all earning 10% annually or better. This activity is more time consuming than your previous activities, but if you're going to eventually invest real money into the stock market, you better make sure you're investing into a stock that is fundamentally awesome. This extra work to identify a solid, financially sound business will greatly enhance the number of successful investments that you will make as an investor. Fortunately, our proprietary software analyzes all this data for our students. In just a few clicks, you'll have all this data done for you. But for now, we want you to do it the old-fashioned way. You need to understand how to do this yourself, where to find the information, and why this information is so important. That's it for this section, and we'll see you over in section number 6, where we're going to talk about technical analysis. Take care.